In this problem, they want you to make differing entries given different assumptions relative to a contribution of $100,000 of cash from investors in exchange for an equity interest or ownership interest in a business. For example, the first one said, assume they issue 10,000 shares of 1 penny par value common stock for $100,000. If this were to happen, you debit cash for $100,000, credit common stock at par value, which is a penny per share times 10,000 shares, or $100, and the excess contributed is to an owner's equity account under contributed capital called paid-in capital in excess of par at common stock. $99,900. So owner's equity is increased because common stock and paid-in capital in excess of par are both owner's equity accounts. The second different assumption is, again, issuing 10,000 shares, but instead of a par value, it's a stated value at 1 penny for the $100,000 contributed. Again, simply debit cash, credit common stock, but instead of par value, you'll credit common stock at stated value for $100. And the additional credit for $99,900 is paid-in capital in excess of stated values on the common stock. The next assumption is that these shares that are issued, 10,000 shares for $100,000, have no par value or stated value. This is easier. Debit cash, $100,000, credit common stock. You might even say credit common stock, no par value, $100,000. Question D is a little more difficult. Assume that the company issues 5,000 shares of 6%, $15 par value preferred stock for $100,000. By the way, at what price are they issuing these shares per share? Well, the company is receiving $100,000 cash and issued 5,000 shares of preferred stock, so the stock is actually being issued at $20 per share, although the par value is $15 per share. In this particular case, if you're going to record the transaction, you're going to debit cash for $100,000 and credit preferred stock distinguishing its par value. $15 a share times 5,000 shares is $75,000. This par value is significant relative to preferred stock because it also serves as a basis for calculating a dividend preference, which we'll do in a moment. In this case, there was also contributed capital in excess of par value for the preferred stock, and we'll do that by crediting paid-in capital or contributed capital in excess of par value on the preferred stock for $25,000. It also asks us to calculate the dividend preference given this preferred stock. The preference is calculated based on the total outstanding par value. You could do this on a per share basis or in total. The total par value is $75,000. The preference is 6%, or $4,500 total dividend preference for all shareholders. You could have done that on a per share basis by taking $15 per share par value times 6% and calculate the dividend preference per share.